as I said, today we will try to cover the real business cycle, what we mean by real business cycle. We try to explain the dynamics between money, financial market, and the real sector. For that reason, generally, today, lots of central banks around the world, because of the recessionary effect that take place after the COVID crisis, especially during the COVID crisis, but more than it, after the rate hike process of the Federal Reserve, we try to explain the dynamics, how the decision in financial and money market will affect the real market indicators. Okay, we will see, try to explain, because you can suppose that why the Federal Reserve decrease and increase in rate hike. What is the reason behind that? Or why 1 week ago the European Central Bank increased their policy rate by 25 basis points? What is the reason behind that? And what are they trying to do? Which indicators they are trying to affect in the real market? Because the interest rate decision made and done by in the financial market, it is a money market decision-making process. But at the end, which type of real market indicators they expect to affect at the end of the process? So we will try to cover those topics in the meantime. As you said, and as the Dr. Lambert emphasized that issue as well, you can directly write your question because you are muted. You can write it in the chat side. And if we have the time to answer all the speakers' question as well, at the end of the session, approximately 10 minutes, we will make a question and answering brainstorming session for the last 10 minutes as well. And here we are, as I said, we have a cyclical indicators from the business market, business cycle. It is the real business cycle. What we mean by that? On the left-hand side, look at the graphs. That is residential investment as a percentage of the real GDP. What we mean by this? If you are decreasing the interest rate, lots of people trying to buy a loan from the residential market, right? Mortgage loan. So if the interest rate decreasing, lots of people going to the loan to mortgage application. And if the residential investment increase as a percentage of the GDP, this means that we are on the positive side, blue side of the real business cycle. This is excellent for us. Let me look at, okay. As I said, if we are trying to check whether we are in the balance for the, just look at the dates here. The dates here is important. From the 1960s until today, approximately 60 years average, we have 4.5% average for the residential investment as a percentage of GDP. And this cycle sometimes drop the average line, below drop the average line, and increase above the average line. If we are in expansionary process, expansionary monetary and fiscal policy side, this investment increase as a percentage of GDP. But if we are in the recessionary process, like 1980s oil crisis, 1970s oil crisis, 1980s Iranian political crisis, and here you see the dot-com boost, the expansion in the monetary and fiscal policy. And during the global financial crisis, just look at, it is decreasing sharply. And here, after the global financial crisis in 2008, it is a recovery process and converging its average line. But directly in the COVID crisis, it is sharply decreased again. So you can even understand from real business cycle, real market indicators, that if there is a recession in the market, you will see this recession effect on the real market graphs and indicators. One of them is residential investment as a percentage of the GDP. Okay. So if we are, maybe you know or not, lots of people know the Maslow hierarchy of needs, right? Maslow hierarchy of needs saying that the people, human beings, have the needs and it has a hierarchy. The bottom, we have basic human needs like water, like breath, like living. And on the top, we have self-confidence. So if we are in good time, we are climbing that hierarchy and we are reaching on the top. And if we are in bad times, we are living just in the bottom line, like the basic needs. So if we are in good times, the residential investment increasing because people are trying to get a better home application, better home condition. But if we are in bad times, they are saying that this house also is enough for us. We need money to sustain our life. And on the right-hand side on the top, as you see, we will have business fixed investment as a percentage of GDP. And business fixed investment meaning that if you own a factory, okay, if you want to buy the new machinery equipment for your factory, this is a business investment, fixed investment, okay? You are trying to buy a machinery equipment, technical equipment. And these generally done in the expansionary process as well. If you own a factory, if you are sell the product to the rest of the world, services product, goods, trade balance you have, and you are producing, let's say, the iron machine or washing machine to the rest of the world, and you are expecting that all the demand increasing from the rest of the world. So you are increasing your investment. But if you expect a recession period in the world, like we have expected today in China and United States, it's approximately 65%. You never make an investment because nobody will buy your machine. Okay, there will be a recession in the market. Nobody will increase their investment. Nobody will rise their investment point as well. For that reason, we will try to cover all these type of topics from business investment as well. So if we see directly from the residential investment as a percentage of GDP or business fixed investment as a percentage of GDP, we can directly understand from the market indicator that if it is a boost cycle, we are in good times. If it is a downside cycle, we are in bad times and a recession period. What we mean by recession? Recession means officially and literally in the literature, we say if the GDP, gross domestic product, contracted in the 2 consecutive quarters, we are in the recession. Okay, if the GDP of the country contracted in the 2 consecutive quarters, we are in the recessionary process. Hang on a sec, just give me 1 second.
So the idea of the real business cycle is to be able to identify when recessions will happen. Is that kind of the purpose of this?
Exactly. We are trying to hear the define from the graph, Dr. Lambert. As everybody in the attendance here see the graph, if the business cycle trend, for instance, what is this graph showing? This graph directly showing how much the people making investment on their residential side as a percentage of GDP. And during approximately 60 years, we have a dashboard line, the dotted line, which is average 4.4. And if the cycle is above this, we are in good times, excellent times. The market is expecting everything will be get better. But if it is dropped to the below average line, this directly means that people are worsening about the expectation. So they are decreasing their demand. They are decreasing their consumption in each type of investment. And we are in the recessionary period. Even just by looking at the graphs, we can even understand the signal, early indicators of the recession effect directly from here as well. And then the below side, light vehicle sales. This is meaning that this is basically vehicle sales. So just think about this. If you don't have money and if you don't have an increase in your salary, if you don't have a good salary and earning expectation, will you change your car? No, because if you buy a good car, you will pay more than you have. And to pay more than you have, you should have an expectation that your salary will be increased, right? Because you don't have enough money at your hand. So if the vehicle sales increasing, people supposing that their salary and income will be increased in the near future. as you see here after the global financial crisis. But as you see in the COVID crisis in 2020, people expecting that the money at their hand even cannot be enough to sustain their life. So they are not changing their vehicles, and all sales of light vehicle decreasing. Okay, these are all real market indicators from the real market, not the financial market. Financial market, you are changing the interest rate, you are changing the policy rate, you are changing the open market operation, you are changing the reserve requirement ratio for the money market indicators. So these are just changing the numbers in the central bank hat. But how these decisions affect the real market, the kitchen, the factory, the machine, the house, the car sales, these are the real market, not the financial market indicators. You can even follow from here that everybody can see how the market expect a better expectation in the near future or a bad expectation in the near future. Or on the last side, top, not the left, bottom right, here, bottom right, total business inventory sales ratio. What does this mean? You have, as a factory, can have lots of inventory at your product, right? And the sales that you done. So if the inventory sales ratio increasing, you are in a bad times because you cannot sell your product. You are always put your product in the inventory, in the depot, right? In the other cycle. So you are not selling. You are putting all your production into the inventory. So if this inventory sales increasing, this means that you are expecting a recession in the market. But if the inventory sales ratio is decreasing, this means that either inventory decreasing or the sales increasing. This means that lots of people buying your products, and for that reason your sales increase. So you are in a good time. No recession, no bad expectation for the near future. So this is also a good market makers and decision maker. And as you see, during the COVID crisis, the inventory sharply rise, as you hear. Every production go to the inventory. Nobody buy anything, no sales. And then it started to decrease after the interest rate hike, and it is still increasing. So meaning that either inventory increasing or the sales decreasing. And today, even in European Union, even in the Federal Reserve, we are always speaking about the recessionary effect. And because of the recessionary expectation, either the inventory decreasing, either the inventory increasing or the sales decreasing. Nobody buy anything. Okay, your inventory in your product increasing or your sales for your product decreasing. For that reason, this ratio is increasing. Okay. And in the next slide, as you see, here we have capital spending leading indicators we have. And profit growth and capital expenditures. This is year-over-year percentage change. What we mean by year-over-year percentage change? We are trying to adjust all these indicators directly in our side with the effective appreciation of our profit growth. Okay, we are trying to increase our profit growth led by capital expenditures, and this is a percentage change. So look at on the left-hand side, this blue line, this light blue is operating EPS, earning per share growth. So this is approximately my profit growth. So if the profit growth, the EPS increasing, I'm thinking that my profit will be increased per share that I hold at my hand. For that reason, it will be like I'm increasing my profit growth and I'm in a good time. And look at the financial crisis. As you see here, 2008, the light blue showing approximately 90%. What does this mean? No profit growth, even no profit there, not growth, even there is no profit. I have a loss. And as you see in the COVID crisis, the light blue also sharply decreased. And these are all profit not growing. It is contracting. I'm losing my profit. And as you see, this capital expenditure also correlated with profit growth. If I have profit, if I have money, then I can convert this money in my capital expenditure, right? So if I don't earn money from my investment, I cannot make any additional capital expenditure for my business cycle. So if we see this blue and black color on the threshold value of the 0%, at least above color, we can easily understand that our investment and our profit side is in a good side, and there will be no recessionary and contractionary monetary or fiscal policy in the market. And on the right-hand side, look at this graph as well. This is capital spending intention over the next 6 months. Why we are saying this is a real business cycle? Because of this. Each central bank, each investment bank have lots of teams that are making regular survey in the real business market. They are going to the factories, they are going to the production center, they are going to manufacturing center, and they are asking those people, what is your expectation of sales for the next 6 months? And they are filling the survey. They are asking, what is your expectation for the capital spending for the next 6 months? And they are expecting. If everybody in the market getting good expectation, getting lots of sales order from the rest of the world for the next 6 months, they are saying that everything is perfect. And we are in good times while we are making our investment and sales decision-making process. So these are directly real market indicators, not Federal Reserve decision. These are the answers of the real market production and manufacturing decision makers, answer for the survey. So as you see, after the COVID crisis, when the central bank take action, their answer is excellently good. Okay, it is excellent, it is increasing. But after the Fed started to interest rate hike process, quantitative tapering process, as you see, next 6 month expectation is contracting here on the graph. Okay, you can easily see from the graph how the real market indicators correlated with and affected from the financial market decision-making process. Because during here, Federal Reserve decreased their interest rate, everybody has cheaper money at their pocket with low cost, and they are spending. They are ordering sales, they are buying manufacturing products, and next 6 months is excellent for the year. Okay. Hang on a sec. Next 6 months here, after the Federal Reserve decreased their interest rate because of the COVID crisis, next 6 month expectation was excellent at those times. But then after the quantitative easing, the Federal Reserve of the United States start to increase their interest rate because of the quantitative tapering process. And then we gradually decrease our expectation for the next couple of months because everybody getting worse. No sales, no order, no manufacturing, and no production. And here, please look at this picture. Look at the residential real estate here. On the left-hand side, we have our housing inventories, right? So if we have housing, not in the sales, but in the inventory, this means that we are going to in a recessionary period. And look at it here. Housing inventories really increased during the global financial crisis because no housing sales happening and no portfolio and no mortgage loan application was made by any type of people. So here, as you see, this small cap here, small increase here that take place during the COVID crisis, meaning that housing inventory is also increasing. But look at this one, single family housing stock. What we mean by everybody wanna buy a single family house, and lots of single family house manufacturers build up new single family houses for their products. And here what we have, as you see, I have a sharp decrease during the global financial crisis because nobody want to buy a single family house. They are saying that we can rent a house, no need to invest, no need to buy a new car, or no need to buy a new house because we can be alive with a rent, so we can use our money to be sustained in the life, right? For our subsistence level. So after the global financial crisis, we a little bit has a recovery in the single family house market. But then during the COVID crisis, it is again sharply decreased because it is a problem again for the general market condition that we can have lots of problem in the meantime because of the single family house start. And in the below side, rental vacancy rate, again the same indicator, or multifamily house. So these are the residential real estate market indicators. So if these indicators getting in a good condition, we can easily understand that the market is going to a good times in the real business cycle. And look at now how these real business indicators affecting from the financial market decision. Okay, we will look at first the Federal Market Reserve and federal financing condition in the financial market indicators. Then we will easily understand how these will be affected from the current condition in real business market cycle. So we will get in touch here. We will get in touch here for the general market indicators like this. Look at the left-hand side. This is the 2023 federal budget, right? And we have here lots of budget consistency, right? Including lots of subcategories of the budget. Here, non-defense expenditure, it is approximately $1 trillion. Defense expenditure, approximately $900 billion. Social security, $1.3 trillion. Medical care, approximately $1.5 trillion. So these are total spending from the federal budget. And today, we have a huge budget deficit, as you see, because of the huge expansionary fiscal policy during the COVID crisis, right? Even the federal government sent directly a cash payment, check payment for their citizen all over the United States as $1,000, right? And this money comes from the budget. So with this expansionary fiscal policy, the United States here, as you see, has a huge federal budget deficit at that time, okay? And here, as you see, these are the minus. Please look at the graph. It can be sometimes misinterpreted. These are the minus, okay, budget deficit. So as you see, if we look at the line here, total budget deficit, it is approximately 7%. It is a huge money. Look at the average here. Approximately we are here around the average 3.5%. But the last 3 years, especially during the COVID crisis, the yearly budget deficit reached approximately 15% as a percentage of the GDP, and then start to decrease, but it is still above the threshold and average line. The average is around the 3%, 3.5%, but the budget deficit today is 7% for the United States. So why the budget deficit is important? Because the fiscal discipline, according to European Union criteria as well, maybe you know, and you hear the Maastricht criteria, right? Maastricht criteria is saying us that any government in the European Union couldn't have a public debt, gross public debt, higher than 60% of the GDP. Okay, so why the Greece and Spain entered the crisis in the 2009? Because their public spending, public expenditure, and public debt ratio increased above the threshold level of the Maastricht criteria, that is 60%. So public gross debt couldn't be higher than 60%, but the budget deficit also cannot be higher than, it shouldn't be higher than the 3%. But what we have at hand today, we have budget deficit 7% for the United States. This is like a bankruptcy for a government for the Maastricht criteria. Okay, so this federal deficit increased, the budget deficit increased because of the COVID crisis, because federal government financed their citizens with the fiscal policy, expansionary fiscal policy. They make lots of things. They send even their utilities, gas, electricity without any money. They send payment directly cash, supporting cash to make them happy. So all this money going through the budget, and that budget should be financed today. So if you see and if you understand a problem in budget deficit, if the budget deficit increasing, what this means, we are making people today happy in the compensation of to make people less happy in the future. Okay, so if our fathers making happy today, their children will be unhappy in the near future, because to be happy today will be financed by the tax in the near future. Okay, if you are happy today with your generation, this cost will be paid by your children. And if you are increasing your tax rate today, your children will be happy in the near future because of huge budget surplus in your government. You can understand this cycle in meantime. Okay, if your tax rate increasing, if your government budget getting better, giving surplus, meaning that all these surpluses will be spending for the happiness or for your next generation. But if you are happy today and your happiness increasing every day, this means that this happiness will be compensated by the tax rate increase for your next generation children, and they will finance your today expenditure. Okay. And in the downside, as you see, we have CBO baseline economic assumption, as we see here. This is the real GDP growth, as we see in the bottom cycle. And this is the 10-year treasury yield. By the way, the real GDP growth is a real market indicator, but the 10-year treasury yield is directly a financial market indicator and reflect how people expect the inflation mechanism in the near future. So if the inflation expectation increasing, 10-year treasury yield also increasing. Why? Because if I am holding, if Dr. Lambert holding the United States 10-year treasury bill, and if the inflation for the 10-year expectation increasing, Dr. Lambert will say that today I have this money, but with the higher inflation, I will get a negative return in the near future because inflation increasing. So to compensate my loss, you should also increase my yield. For that reason, 10-year treasury yield going down. Okay, if inflation expectation rising, my 10-year treasury yield should be increased to compensate my loss of inflationary effect. Okay, then headline CPI, as you see here, for the average, you can see here as well. Okay, the average dashboard forecast for the economic assumption. And today, headline CPI, it is approximately 6%. This is not normal. This is normal in Turkey. We have officially 60% of inflation, but this is not normal for the United States. Their average and their target level is just 2%. Okay, so it is 3 times higher than their expectation and targeted level. So this headline inflation for the Federal Reserve cannot be sustainable level. Okay, this cannot be a sustainable level for the Federal Reserve. They are doing every monetary policy and fiscal policy implementation to decrease this inflationary effect in the government. And the unemployment ratio as well. Maybe I mentioned this topic earlier, but if I don't mention, I will try to state those issues as well. You know, the Federal Reserve always stating that we will try to decrease the inflation without increase the unemployment. Why? Why they are stating while speaking about inflation, about the unemployment issue? Why it is matter? Because inflation and unemployment has a direct and strict correlation because of the Phillips curve. Okay, Phillips curve saying that prices, meaning inflation, has a directly negative relationship with unemployment, meaning that if the inflation increasing, unemployment rate will decrease. And this is a good indicator. But we have an unemployment rate target approximately 4% in the United States, but the unemployment rate in the last month, not during the 2023, but the last month, below the threshold value 4%, it is 3.6, okay, 3.6%. So I achieve every target that I want to do during the COVID crisis about the unemployment issue, because you will see now in a few slides later, you will see that how the unemployment rate increased about the 15% during the COVID crisis in the United States. But then with the direct and correct measures of the United States, how those unemployment rate decreased to the 3%. But as I say, if we are decreasing the unemployment rate, we are trying to increase the inflation. But I have also an inflation target, not just the unemployment target. So 2% of inflation and 4% of unemployment target, and they will be balanced each other. So if I want to decrease my inflation rate, and if I know inflation and unemployment has a negative relationship because of the Phillips curve, so decrease in inflation will create an increase in unemployment. But I don't want to increase unemployment above the 4% level. So Fed is really crucial. Fed is really prudential while making monetary policy decision in the Federal Reserve Open Market Committee. Lots of people supposing that why they are increasing their interest rate or why they don't decrease their interest rate. These are not playing a gamble in the Las Vegas. Okay, these decision process are not like playing gamble in the Las Vegas or Monte Carlo. These are really prudential process, and you should be very, very careful while taking from the United States. Okay, I think there is some question from here. Let me check from the chat side. And question, are the findings presented from US, EU, or any part of the world? Yes, this part is United States, but in a few slides later, you will see the European Union as well. I choose biggest economies from the different parts of the world. This is for United States, but in the next couple of slides, you will see the European Union indicators as well. And here, as you see, the Federal Reserve gross debt. What do you mean by gross debt? A few minutes ago, I said to you, I don't want to increase my public debt above the 60%. And I don't want to increase my budget deficit above the 3%. These are the Maastricht criteria in European Union. But as you see, the gross public debt approximately 120%. 2 times higher than Maastricht criteria, 6%. And the budget deficit as well. It is 3.3% in Maastricht criteria, but here it is approximately 7%. And consumer finance. How we are financing this type of expenditure from the consumer side as well. So we should understand the basic dynamics behind the consumer finances as well, while making how this public expenditure, consumer expenditure, and their balance sheet happening. So in consumer balance sheet, this is in the $1 trillion in the first quarter of the 2023, and these data sets are not seasonally adjusted, and approximately this part, approximately $30 trillion is in homes, and approximately $10 trillion is other tangible, and approximately $17 trillion, 9%, around the deposits money, and pension fund, 20%, approximately $20 trillion, and other financial assets, meaning that lots of different financial assets I can have, even gold, even ETF. These are not included, but it is approximately $7 trillion, and it is a huge money as well. And on the right-hand side, household debt service ratio. What does this mean? How the household can pay their debt service. So if it is decreasing, we are in a good time, and if it is increasing, we are in a bad time. During approximately after the global financial crisis, the house service debt service ratio. So I couldn't pay. Sorry for the misinterpretation. If it is decreasing, it is not a good time, because I couldn't pay my debt services. I have debt, but I couldn't pay that. So if it is decreasing, I'm not paying even 10% of my debt, overall debt. And even COVID crisis, it is decreased more than 2%, and it reached around to 8% level. So overall debt, only 8% paid during the 1 year. But after the Federal Reserve take action to make people consumer budget better, then their capability to pay their debt increased from 8% to 10%. This is also good for the consumer side, consumer happiness. And from the personal saving rate, meaning that if I saving my money, if I'm not consuming, this is good for my budget. But if everybody do the same, what does this mean? If one save in the market, it is good for the economy. But if everybody save the money, it is not good to money. It is not good to market. So if everybody increase their saving ratio, this means that nobody consuming. If nobody consuming, I cannot sell any product. There will not be any production in the market, and market will be shrink. So please remember this idea. If one person increase their saving ratio, this is good. But if everybody increase their saving ratio, this is not. Okay, somebody should consume. And in return, there will be production. If nobody consume, there will be no production. There will be no GDP growth there. Okay. So if the saving ratio increase, as we said here, like in the COVID crisis, this is not good. Everybody is saving. Nobody is consuming money. And saving ratio here dropped around 4% level because of the cheaper money, cheaper interest rate. Then it is increasing because of the quantitative tapering, as you see in the light blue line here. Okay. And here we have household excess saving. Here we have the trend line. And if this line going up on the threshold value, this is not good. During the COVID crisis, as we see, we have a huge saving ratio. Okay. And this is not a good market indicator for us. And the revolving consumer credit outstanding here. This is the percentage of disposable income, as you see. This is not a seasonal adjusted average. Okay, this is seasonal adjusted. And consumer credit outstanding means that how much consumer credit money as a percentage of disposable income at hand in the money market we have. And during the COVID crisis, there is no consumer credit because nobody consumed money. But now we will have lots of consumer credit at my hand to finance our budget and to finance our consumer spending happinesses. As you see here, our market indicators for the labor market dashboard on the non-farm payroll, meaning that if my non-farm payroll increase, this means that lots of people make a payroll application. And if it is increasing, this is not good for the economy. If it is decreasing, this is good because everybody happy and nobody making a non-farm payroll application. And here on the right-hand side, we have a labor force participation rate. And this is good for our economy if my labor force participation increasing. Lots of people will be in the labor market and they will increase their contribution to the growth. And this will be a good indicator for the labor market indicators. And when we integrate with those indicators with domestic market, real market sensitivity. And here, as we see, initial jobless claim, continuing claim. For instance, initial jobless claim is if this indicator is rising, this is not good because people are getting jobless and unemployed. But if there's non-farm payroll decreasing, it is good for us, right? Or if non-farm payroll, I'm increasing my employment condition, it is good for us as well. And unemployment ratio, what I said here a few minutes ago, look at the unemployment ratio in United States during the COVID crisis, 15%. And because of this unemployment ratio is not sustainable, the United States tried to decrease its threshold value, unemployment rate threshold value. It is here, okay? It is 4% for my side. For that reason, we decreased our interest rate during the global financial crisis and COVID crisis. We increased the demand. We increased the employment condition, and unemployment rate decreased approximately threshold value here in the United States as well. And the 50 years average for the United States is 6.2%. And current level is strictly below the average level. So this is a really good sign and indicator for the employment market for the United States. And you will see here the dollar drivers, the United States dollar drivers. So how the dollar gaining strength along the market level for the United States, this will be directly achieved by which market indicators trigger our United States dollar perspective, which indicators I'm using while I am making the dollar market indicators there. So it will be my dollar drivers like the United States trade balance on the right-hand side. So if the United States sell lots of products, export lots of products to the rest of the world, then they import, this will be getting strength to your United States dollar. Or the interest rate differential. So if my interest rate increasing comparing with the rest of the world, this means that my interest rate will be higher in the near future. I will get capital inflow, everybody demanding United States dollar, and the dollar getting strength again here as well. And the oil market. Today, it is a hot topic and controversial topic on these days because of the oil cut from OPEC countries, Russia and United States trying to persuade Iran to increase their oil production because oil prices now above the $93 as a Brent petrol with the barrel per barrel United States dollar. So it approximately decreased 75 and it is gaining strength. Please remember the Russian-Ukraine conflict and the per barrel oil petroleum products reached above the $140. So today, as you see, we have an increase in the oil prices. And it is here for now, but the price is going up. It is like 90. We are here today, okay? And the crude oil inventories, if the crude oil inventories for the United States increasing, this means that the United States finding cheaper oil products don't want to sell their oils to the rest of the world with these prices. And if the oil market inventories are increasing, the prices is going down. But the reverse is happening. Oil market inventory is decreasing. So it is because of the prices is rising. Okay. And here that the all financial and real market indicators affected from this financial market decision-making process. This is the Federal Reserve interest rate application, the Federal Open Market Committee application for the Federal Reserve rate. And it is, look at this picture, during the global financial crisis, it is decreased to zero lower bound. And after the 2014 and 15, because of the quantitative tapering process, it increased. And with the start of the COVID crisis, it is decreased again zero lower bound. And now the United States increased their Federal Reserve rate around to 5.5. And this is a huge cost of funding. It is really high interest rate for the Federal Open Market Committee after the global financial crisis and during the 25 years. So the market expecting that this rate will be decreased around 2.5% and 2% with the long run target of the Federal Reserve Open Market Committee. And this interest rate decrease will boost the consumption, will boost the economy, and there will be no recessionary effect in the coming months after the 2025. And here, this is not just for the Federal Reserve, but this is a true valid information even for the other developed market central banks. These are the Federal Reserve, Bank of Japan, as you see, the dark blue, light blue, the European Central Bank, and the green is Bank of England. And today, the bond purchases of total of approximately $5 trillion during the COVID crisis. $5 trillion. This is higher than an economy. This is bigger than France. Okay, this is a huge money. So $5 trillion central bank fixed income securities buying, asset based securities and mortgage based securities buying program from the Federal Open Market Committee because of the quantitative easing process. And with this, they, after this COVID process, as you see, their increasing of the total in the orange line decreasing. They are not buying bonds. Even they are selling the bonds and increasing the interest rate. Look at the interest rate here. These are the interest rate as the orange line decreasing, bond purchases from the market decreasing. They are selling the bonds and increasing the interest rate. And here we are for the Eurozone economy, for the real market indicators as well. Look at this picture. Lastly, this is our Eurozone economy. Hang on a sec. Before passing this, I have a question from the Azizo Cheo. Question is, if people are not consumers, like during COVID-19 crisis picture, what are the direct consequences on the banks, markets, and other financial institutions? As you see, the answer for this is this. If people are not consuming anything, nobody is consuming. Banking are not selling the products. People are not consuming. What is happening? This is happening. Growth and capital expenditure directly decreasing. Operating EPS decreasing for the banks here, and capital expenditure for real business production center decreasing. So if people are not consumed, our operating earning per share growth, earning per share, meaning that our earning, our profit decreasing. Okay, and for my capital, for my production, I don't want to make any additional capital expenditure because nobody is buying anything. So no need to produce more. Okay, the production at my hand is enough to match the people requirement and needs. No need to increase production or capital expenditure. Okay, I think the question is clear and the answer is clear for that side. And here we are in the Eurozone unemployment rate and the wage growth. This will be directly related with the Eurozone unemployment ratio. And look at the picture. As you see, Eurozone unemployment is just increased from the 7% to 8%. Why it is not increasing 15%? Because Eurozone is a production economy and the United States is a financial market economy. So Eurozone employment condition is better than the United States. So their unemployment not rising like United States. And here we have their unemployment rate is decreasing. But because of the inflation, their wage growth is increasing more than that. Look at the wage growth in the right-hand side. Wage growth is normally around 1.5%, but today in the European Union, we have approximately 4.3% wage growth. This is huge because of the inflation. And here, Eurozone in interest rate and inflation expectation. As you see, if the inflation increase, our interest rate expectation increasing. I gave you to Dr. Lambert example. If the Dr. Lambert holding a 10-year treasury yield, and if the inflation is increasing, Dr. Lambert will say that because inflation increasing, I'm losing money. You should increase your interest rate and my return on that treasury. Okay, the logic is directly from this. If inflation expectation is rising, my yield expectation should be raised as well. And on the right-hand side, we have government capital spending. And during the financial crisis, as you see, we don't have any government capital spending. And here we have also Eurozone crisis because of the Greece, Spain, and Portugal. And after that, as you see here, government capital spending is good because Eurozone, as I said, a production economy, and they are really give a huge importance for their production center, and their employment condition is better than the United States as well.